Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending April 8th, 2022. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is the Fed choir seems to be singing in harmony. What do I mean by that? Well, let's kind of get into the markets and see where everything's going right now. We'll take a look at the weekly sound bites. Starting off with the index performance for the U.S. markets, you can see everybody's in the red, both weekly and year to date. Weekly, the worst performer was the Russell Small Cap. Nasdaq coming up number 2 is the next worst performer for the week. Both those two, by the way, Nasdaq and Russell, as you can see year to date, are both in correction territory. Dow and S&P also in the red. So we finished out Q1, starting Q2, everybody in the red as we go into earnings next week. You can see U.S. valuations on the right-hand side. PE ratio, the forward PE is about 19.97, still in my mind elevated a pretty good little bit based on what we've got looking forward over the next 24 months. And you can see the dividend yield in the S&P is at 1.4. 10-year Treasury jumped a big amount this past week. It's up at 2.71. Earnings yield for the S&P is at 4.47%. So that's still better than the Treasury. You can see the yield of the S&P over the 10-year Treasury is still over 2%. The real yield, by the way, when you factor in inflation, to minus 5.19, that'll still be positive net for gold and the precious metals. Current VIX finished out the week at 21.16. You can see is up just a little bit for the week. Worst performer for this past week, technology, 3.82%. It's also Nasdaq, you can see, with higher interest rates and a big jump in the 10-year, really put the hurt on technology. Best was healthcare. Healthcare, by the way, was the worst the prior week, so it's a little bit of a bounce off the lows. Typically, healthcare does much better in a rising interest rate, slowing growth kind of economy. Energy, still the best for the year at 44.67%. Technology's not only led the way for the week, but it's also leading the way for the year, as far as the worst performer. And of course, if we look at the economic data, stocks pretty much had, as I said, it started off sharply lower on Tuesday when Fed Governor Lael Brainard came out. And by the way, she's considered very dovish, said in a speech that the Fed's going to start looking at reducing their balance sheet as early as their May meeting. Now, in May, they typically meet the third week of the month, but we don't have a meeting this month in April. Most of the economic data is going to be around inflationary data and earnings starting off next week, as I said. But in May, their first meeting's May the 4th. So right as we kick off May, we're going to get May 4th. We'll get their policy statement and their press conference by Boom Boom Powell. But later in the day, Fed Kansas City President Esther George came out, told Bloomberg that there's no question they had to act rapidly. So naturally, the markets didn't really like that, right? Just a lot of activity. Now, the economic calendar is also relatively light this week. We did get jobless claims, okay? Jobless claims came in, a little bit, fell a little bit more than expected, 166,000, lowest number since 1968. And then the ISM, the supply management gauge for service sector, came in slightly below consensus. So we are seeing a slowing of the economy. And of course, if we look at U.S. Treasuries, well, midweek, as I said, the Fed meeting minutes kind of hit the news wires, looking at reducing the balance sheet by about $95 billion a month. Now, that's going to have a worse effect on equities, I believe, than just the Fed simply raising the rates. Someone's got to make up that trough of demand in the marketplace when we go to auction our treasuries. So typically some other entity making up the Feds is going to ask a higher interest rate. So we're going to see rates come up over that. The consensus was around 80 billion. So the Fed's going to be a little bit more aggressive. Meanwhile, the minutes showed that they were prepared to raise their rates by 50 basis points in May. So by the end of the week, the futures market was predicting the most likely scenario would be the Fed funds target rate to hit 2.5 to 2.75% by the end of this year. And that's well above its current range right now, 25 basis points. So they got a lot of work to do. They got 2.25% anticipated coming in before the end of this year. So their plans for their rapid quantitative tightening by reducing its balance sheet is what really drove the benchmark 10-year rates this year or this past week to its highest level since 2019. Okay. And the yield curve, which briefly inverted, not this past Friday, but the last Friday, bounced back up into the green again when the 10-year just took off this week with the balance sheet reduction in comments and statements. Okay. So a lot there. Now, if we look over in Europe and we see the activity over in Europe, the only major index that we follow that's in the green, both weekly and year to date, was the FTSE over in the UK. And by the way, they've already raised their rates 3 times this year. The central bank, the Bank of England, has raised their rates 3 times already. So, and the Feds, we've only done it once here. So everybody else in the red across Europe, and you can see the DAX, the German markets are in official correction territory. They moved into it this week. Okay. The other news, the European Union also joined the U.S. in imposing more sanctions on Russia. And we're getting minutes from the ECB's March meeting that revealed a lot of them believe that this persistence of higher inflation coming to Europe is calling for more immediate steps to normalize monetary policy. And in between the lines, that basically means they're going to be more quantitative tightening, getting the rates up a little bit. So we'll probably see more of that. And with all of that as a backdrop, including a war on their eastern front of NATO, European countries, a lot of investor morale in the Eurozone fell to its lowest level in almost 2 years, right? And on top of that, German factory orders fell a good deal in February, driven mainly by a decline in foreign orders. So Europe's not looking that well right now, okay? And then, of course, if we just swing over to the Asian markets, we look at Bank of Japan. They're committed to a very powerful monetary easing in pursuit of their 2% inflation target. But that kind of reminds me of the cartoon of the Road Runner and Wile E. Coyote. He's always trying to capture that Road Runner, but he can never capture it. That's going to be like the Bank of Japan trying to get an inflation target there. They're just never going to get there. At least they haven't over the past 2 decades, no matter what they try. And just as a side note, perhaps it's because the Bank of Japan owns 70% of all active ETFs in the Japanese stock market, right? And they own about 90% of all outstanding bonds in the Japanese market. So it truly is a market of the government over in Japan. So, talk about market manipulation. They just took it to a whole new level in Japan. By the way, the IMF also downgraded its projection for Japanese economic growth this year from 3.3% down to 2.4%. That's a big drop, folks. It's also expecting to pick up inflation. So we're seeing growth expectations drop globally. We're seeing inflation staying strong, and we're seeing interest rates going higher. Not a good toxic cocktail for the markets. Actually, that's what it exactly is. And then, of course, in the Chinese markets, those idiots over there, they're still addressing their COVID outbreak in Shanghai much more aggressively than the rest of the planet is. So it's causing the risk appetite in China to be much lower. You can also see that in China, they're in official correction territory along with Germany over in Europe. Everybody was in the red over in there, the Nikkei, China, and the Hang Seng. Hang Seng was also down. We did get the Chinese services purchases PMI data out, and that sank to 42 in March from 50. Remember, anything below 50 is contraction. So it's at 42. It's the lowest level it's been since the pandemic started. So we're not seeing a lot of good news. I'm not seeing a lot of good news economically. Now, we got U.S. earnings coming up this week. If we don't hit the ball out of the park with earnings, I think we're going to see some more downside in the market. And I was telling all our members we can expect some downside through the middle of this next week. And then if we get some stronger than expected earnings, that will provide some lift to the markets. But I think this sell in May and go away concept is probably going to be very strong. And we're going to see, unlike the past 2 years when summer months were very strong, I think these summer months are going to be relatively weak for the markets with the Fed's hiking, growth slowing, inflation high. That's going to drive markets lower. All right. Now, let me switch the screen over here and just get you guys over to a couple of key things that I've been telling our members. and we've been following it very closely, and that's something that I wanted to see us hold up through for earnings. I don't know if we'll be able to do it, but it's something very important that we want to see. So what's coming up on the screen here, it should pop up very soon, is the you'll see here the uh, um, S&P 500 E-mini futures, right? And as we get that up on the screen, you can see that the key level here, the red line is the 50 EMA, the yellow line is the 200 EMA. We're holding it up very closely. Those are going to be, this is more of a resistance support zone for us. This is kind of a resistance zone up above. But I want to hold that level. You can see intraday, we've moved through it. Wednesday, Thursday, Friday, we just barely came right just north of the line. 200 EMA is sitting below it. So this is the only index, by the way, in the U.S. where the 50 is over the 200 EMA. All the other indexes have a bear market look and feel to them. Okay. You can see here that we're still below the closing price at 2021. Are we going to test the 2022 lows when we were down 14.69%? If we have strong earnings, no, I don't believe so. I believe that the 200 at least should hold us up. We should come up and challenge this pivot high right here, sitting around 46.25. If the earnings come in and they underperform, coupled with higher rising interest rates and inflation, then I think we're going to take this zone out here, take out the 200 EMA and come back down and challenge this area down here. Okay. And of course, if we look at Nasdaq, this was the one that got hit the hardest. You can see the 50 EMA is running almost parallel to the 200 EMA, but it's below the 200 EMA. This is the bear looking chart, bear market chart. Interest rates are going to continue to push technology companies lower. Okay, you can see we were officially in a bear market territory just very briefly, if not for just one day. We were down 22.31% in Nasdaq futures. Now, it's 100 of the largest tech companies in Nasdaq, but it's an ugly looking chart. We had the death cross there. That's when the 50 crosses the 200 back on the beginning of March. And then we've had this huge bounce here for about the last half of March going into early April, and now we're having a normal pullback here. So we got to see. It's all going to be in the hands of earnings, folks, coming up over the next couple of weeks. Now, this week coming up, we kick it off. Big data coming out Tuesday. We get the CPI data. It's forecasted to come in around 8.4%. The last reading was 7.9, so inflation's expected to go up just a little bit. We do get some bank earnings on Tuesday. We get Fifth Third, Bank of New York. Always the first week of earnings, we always get the banks. Now Wednesday, it's going to be a big day for banks. We get J.P. Morgan, we get BlackRock, and then that's met on Thursday by Wells, U.S. Bancorp, Goldman Sachs, Morgan Stanley, Citi, State Street, Ally Financial. So we get a lot of bank earnings coming out this week, and the bar is very low for them. So if they can hold up and show some strength, that would help the markets. But I think it's a coin toss right now, to be honest. So that's a little bit about what I'm looking at there on these indexes. If we look at the worst performing index, which is the Russell, excuse me, you can see the death cross actually happened right at the beginning of the year. Folks, this is a bear market chart, without question. The 50 EMA is spreading away and turning lower from the 200 EMA. Price action is below the 50, which is below the 200. I think the odds favor us coming down here and testing these lows here. If they do that, it's going to pull everybody else down. Okay, I keep double clicking on this thing. It's going to pull everybody else down. So that's another ugly looking chart. And then finally, if we look at the Dow was really one of the lone holdouts on Friday. Notice the Dow, the 200 EMA is also above the 50, or said another way, we had a death cross back in early March. The 50 is still below the 200, but it looks like the 50 is a little bit more bullish than the 200. And it's, even though it's a bear market chart, we are above the 200 and the 50 EMA in the Dow. All right. Most of the Dow's earnings come from offshore, about 60%. So it's only 30 large international companies. So that's holding up a little bit better with the stronger dollar. That helps the corporate earnings of these companies collecting in US dollars offshore. So that's helping out a little bit, but still very weak. I need to see a little bit of follow through in all of these. And of course, if we look at the VIX, it came in just a little bit on Friday, but you can see we're still in this light red colored zone. It's in a down fast market zone for the VIX. So we have to be very careful. All right. I mean, and again, everything's going to depend on where earnings come in this next week. If we look at the 30-year bond, we've been short the bond. We're continuing to make new lows. I was getting our members short bonds way back a while ago, back over in this congested zone right over here, right? You can see the 50 and 200. I was suggesting every up move you want to sell, every rally. And then finally, it just gave it up here in the month of March. I mean, we started the month of March at about 159, almost 160, and now we're sitting down here at 142. All right, that's 18,000 handles. That's $18,000 per contract in the bond futures market per contract. You could have done very well in because we were looking at putting on so I suggest to our members getting into the bond options market and just playing this thing. Now, we're going to have a bounce back because I think we've extended a little bit further than normal, but the big play was in the ETFs, and a lot of our members are just playing it the perfect way, right? So we're making great money on this interest rate rise. 99%, I saw a survey that 99% of investors, I don't know who that 1% is, but 99% expect interest rates to go higher. Well, duh. But a big part of the sell-off has already happened. So if you're late to the dance, I wouldn't jump in shorting bonds right now. We'll probably have a little bit of a bounce once we get into earnings. Okay. So just kind of keep that in mind. If we get into the currency market, well, you're going to see the same thing with the US dollar. The US dollar is constantly making new highs, and it's really a dollar index. Okay. If you look at the dollar index, I just got to get this right here because these lines just really mess things up. It just kind of messes things up a little bit here. Let's get that. There we go. So 99.85, the index. That was my prior resistance point, which is now obviously becoming support. So we're sitting near or at 2022 highs for the US dollar. Okay. Compared to other currencies, the euro, just the opposite. It's down now about $1.09 per dollar. We're coming back down and testing these lows. I do believe we may make one more low. If we get a negotiated settlement with Ukraine and Russia, you're going to see the euro take off like a bat out of hell straight up. That would be a long play that you want to make. Okay. Outside of that, I wouldn't touch it right now. And then, of course, if we come down and look at gold, I like gold, especially with the real yields being negative. It's been consolidating here going all the way back to the middle of March, just a long consolidation period. I don't like gold when it goes up that rapid because you can expect to sell off, but this consolidation period, I think this breakout here, you could probably go long gold. And with our members, I'll review in detail a couple of interesting ways to play gold to the upside over the next remaining part of this year, rather. I think there's going to be some good opportunities in gold. So that's a little bit about how I'm looking at gold. Same thing with silver. Now, silver's got a higher beta, meaning it moves on a return on capital basis faster than gold. You can see the 50 just crossed above the 200, which is a bullish sign. Did that the end of March. So I think we got higher moves in both of these things. As long as that real yield stays negative, it's going to be bullish gold. Okay. Same thing with copper. Now, we haven't been in copper in a while. Freeport-McMoRan's a good way to play it. But be very careful up here. It's going to be very choppy. It's a choppy play anyway, to be honest. And if we look at oil, this is another one that we've got to trade on, or I've recommended to our members a great way to play oil. I think eventually it's going to come back into the high 80s, but right now, this is where we're sitting. If they get a negotiated settlement with Russia and Ukraine again, you'll see oil come down at least $7 or $8 a barrel overnight. right? But these sanctions are providing some support and wind in the sail of the bulls. You can see we just had a major break of the 50 EMA. You can see it held up right there, and it held up a lot over here. So that break means oil is probably going to come down into the high 80s, but there's some really interesting ways to play this trade, especially given the volatility in the oil markets with options on oil futures. So really interesting plays setting up in that. And then the other one that we like, if we look at natural gas futures, I got to find it on my screen here. Where are we? I know we're on here. Here we go. Right. Yeah. Nat gas futures. I like the way nat gas has been moving higher. You see this move here? That is a very bullish move. Unlike these spikes here, when you get speculation, you get a lot of stops being run and it causes these spikes. These are great spikes to fade the move up back down again. This, folks, is a completely different evolution. This is longer term demand for nat gas, primarily in Europe as they get off of Russian nat gas. You're going to see nat gas stay higher for longer than we've seen in a long, long time. All right, everybody, that's just a quick update on the global markets and a couple of key indexes and commodities here in the U.S. Members, we got a session tomorrow evening. If you're not a member, I highly encourage you to come in. We're doing really well. We're off to a positive start this year as well. Everybody have a really great weekend. Members, I'll see you Sunday evening for our weekly market watch. Take care, folks. Ciao.